All right, welcome to The Explainer. Today, we're stripping away absolutely all the noise. Let me share something that took one of the greatest financial minds in history, Charlie Munger, about 8 decades to fully internalize. And it's this: wealth is not complicated. The people who make it complicated are usually either trying to sell you something or, honestly, they're just fooling themselves. Now, we aren't going to look at any cotton candy motivation today, that stuff that tastes super sweet but has absolutely zero substance. Instead, we're going to walk right through the raw, unfiltered framework that compounded wealth across 7 decades for Munger and essentially built Berkshire Hathaway. This explainer is all about highlighting the true, literal difference between just knowing what to do and actually doing it. Okay, let's just quickly dive into our roadmap for today. We'll be hitting the simplicity of wealth, the 3 pillars of awareness, the complexity trap, performing versus building, and finally, wrapping up with time and personal risk.
Starting with part 1, the simplicity of wealth and how we actually close that massive gap between knowing and doing.
Look, the absolute foundational virtue of personal finance, the one single thing that underlies absolutely everything else we're going to look at today, is delayed gratification. But to execute that mechanically, you need a hard and fast rule. So when you're facing an ordinary purchase, ask yourself this one acid test question: can I afford to buy this twice? It's not about whether you have the exact dollar amount sitting in your checking account right this second. It's about whether buying it twice would be genuinely comfortable for you. If the answer is no, then you can't actually afford it once. If you go ahead and buy it anyway, you're literally just borrowing your own future security to fund your present pleasure. And let me tell you, compound interest works exactly as well against you as it does for you.
So why do we fail that test so often? Well, it comes down to a psychological hurdle called hyperbolic discounting. The human brain is quite literally wired for the present. We assign this massive, outsized value to things we can have right now, and we dramatically discount rewards that come later. It is the core psychological quirk that keeps most people broke. To beat it, you really have to zoom out. When you're making big decisions, and I mean not just purchases, but career, investment, and big life decisions, zoom out 10 or 20 years, because short-term thinking only ever produces short-term results.
Moving on to part 2, the 3 pillars of awareness. This is the mechanical framework.
Most of the financial advice you stumble across online involves these wildly elaborate spreadsheets like 17 different tracking apps and obsessive daily check-ins. Guys, that's just financial cosplay. You don't need to play dress-up as a financially responsible adult. You really just need to track 3 key numbers. First, your fixed expenses as a percentage of your total income. Second, your savings rate, and notice I said percentage there, not the absolute dollar amount. A person earning $30,000 a year who saves 30%, they will vastly outcompound someone pulling in $100,000 who only saves 5%. It's just math. Finally, track your net worth quarterly. Not to make yourself feel good or bad, but simply because you cannot manage what you do not measure.
Let's look a little closer at that first pillar for a second. If your fixed expenses, meaning your housing, your transportation, insurance, utilities, if those are consuming 50 to 60% of what you earn, you are sitting in a structurally dangerous position. You have absolutely zero margin for error. One job loss, one unexpected medical event, or just a broken down car, and you're in serious trouble. You have to aggressively, and honestly quite unsentimentally, get that number down.
So how do these pillars actually work together early on? Think about the math of your first $100,000. If you save $13,000 a year at a 7.5% annual return, it takes about 6 years to hit that 100K milestone. But the composition of that money is what's incredible. 77% of that wealth came directly from your savings contributions. Only 23% came from actual investment returns. The compounding engine is magnificent, sure, but it requires fuel. And in those early years, that fuel is just direct, unglamorous savings. Your exact portfolio choice barely even matters at this stage compared to your savings rate.
All right, part 3, the trap of complexity, and why doing absolutely nothing usually wins. People who would never even dream of attempting to perform their own brain surgery are somehow fully convinced they can construct a highly complex, superior investment portfolio completely from scratch. It's kind of baffling. The data here is unambiguous. Over a 15-year period, a simple passive index investor outperforms more than 90% of active professional large-cap fund managers. And let me just repeat that for emphasis, not 90% of amateurs. 90% of the professionals who do this full-time. Complexity is the enemy here. Adding 12 different overlapping ETFs doesn't actually diversify you, it just gives you the illusion of sophistication.
Financial psychology expert Morgan Housel has this famous saying, "Successful investing is losing the password to your investment account." And it's not just a funny joke, it's a legitimate strategy.
The investor who checks their portfolio every single day is systematically destroying their own returns through transaction costs and emotional, highly reactive decisions. If you can just embrace extreme boredom, ignore the financial media that's out there manufacturing a brand new crisis every single week, and just leave your index funds alone, you will very likely end up in the top 5% of all investors.
Now consider this fascinating timeline based on findings from the blog of Dollars and Data. People are constantly trying to time the market, right? They're always sweating over whether stocks are too expensive right now. And sure, in a 5-year window, if the market is overvalued, returns might decrease. But look at what happens when you just stretch your timeline out. Over any 20-year period in American stock market history, real negative returns are extraordinarily rare. Over 30 years, they essentially do not exist. Think back to 2012. The S&P was at 1,400, and articles everywhere were screaming that it was 50% overvalued. Anyone who stayed out of the market back then out of fear missed one of the greatest bull runs in modern history because they tried to time it. Time in the market is literally your greatest, most democratizing edge.
Which brings us to part 4, performing versus building wealth. I call this the appearance trap.
This right here is a massive, massive trap in our modern culture. Borrowing money is a powerful tool, absolutely, but its value depends entirely on how you use it. Borrowing to build means financing assets that appreciate. Think a business, certain real estate, or education that genuinely expands your earning power. That can be a very rational move. But borrowing to consume, that is compounded stupidity. Imagine borrowing at 6 to 8% interest to buy a car that loses 30% of its value in the very first year. You are bleeding money from 2 directions at once. Or financing a $2,000 sofa at 24% interest only to find the thing is barely worth $200 3 years later. This is the hallmark financial habit of people who never ever build wealth. And honestly, social media has made this so much worse. We're constantly comparing our messy, internal financial reality and our debt to someone else's highly curated, fictional presentation of their life. But the actual self-made millionaires, the ones studied in the Millionaire Next Door, they live by a really simple rule. If your motive is to make money just to spend money on the good life, you are never going to make it. The folks who quietly built 8-figure net worths, they didn't look like millionaires. They drove ordinary cars, they lived in modest neighborhoods, and they focused on accumulation over looking rich. The person who spends aggressively to maintain the appearance of wealth is merely performing wealth, and that performance completely crowds out the behaviors needed to actually build it.
Finally, part 5, time and personal risk. This is about filtering the advice. We have to understand that risk isn't just some objective property of an investment, it is the relationship between the investment itself and the person making it. Let's say you have a 25-year-old with a 40-year time horizon. For them, a portfolio of 100% broad index funds is entirely rational. They have the time to absorb all the volatility. But for a 60-year-old who's approaching retirement and needs to access that capital soon, that exact same 100% equity portfolio is genuinely dangerous. A sudden market downturn could permanently wipe out their retirement stability. So you can't just blindly copy what you see online. You absolutely must apply the filter of your own personal situation, your specific timeline, and your own emotional tolerance.
To really wrap up Munger's entire framework here, the thread that runs through it all just comes down to the boring basics. Clear thinking and patience will always win. You save aggressively, you invest in simple index funds, you hold them for decades, and you spend less than you earn. You completely ignore whatever fancy new thing your neighbors are driving, and you realize that frantic trading activity is definitely not the same thing as financial progress. The information has been out there for decades, guys. The principles are completely known.
Which leaves us with one final, absolutely essential question. Knowing the path isn't the problem, actually walking it is. So are you willing to be the rare person who genuinely internalizes this unglamorous patient framework? Or will you just be another spectator performing the appearance of wealth while sacrificing the reality of it? The choice is entirely up to you. Thanks so much for joining me on this explainer, and I will catch you in the next one.